Well, good afternoon and welcome to our High Rock weekly client webinar. If you want to skip over any part of this webcast, please feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We do have a bit of a new format that we've been working into this each week, where it's a bit of more of a dialogue. Paul joins in and gives his opinions, and we kind of get a dialogue going. So hopefully you're enjoying that change. I'm Scott Tomlinson, and joining us on the call today, as I said, is my partner and colleague, Paul Tepsich, the founder of High Rock, and our certified financial planning professional, wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child. She does remain on call to us for her expert advice and assistance should we need it for you. Well, each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit the home page on our website and click on the Introduction to High Rock Private Client button. Well, as you all know, we manage risk first and foremost. And at the moment, stock market risk is no longer being protected by bond market safety, as it historically has been for balanced portfolios in Canada. Bond yields have soared and prices have fallen, and stock prices have not moved with them to provide any offset. So balanced portfolios are showing losses, especially if they are overexposed to Canadian stocks. Paul, any commentary this week on our correlations?
Yeah, they seem to be subsiding a little bit, thankfully. So the bond market, as most people know, has had a really rough ride, and you can see that in the upper part of the chart in the dark green. That is the yield, bond yield. So the yield has gone up from roughly 140 near the end of June to where it is today at 192. It's a big move, and that means yields up, prices down. It seems to, in the bottom part of the chart, you can see that red shaded area seems to be moving sort of flattish right now. So the bond market seems to be stabilizing a bit, which is good news. And hopefully we get back to the proper correlation where it does provide protection, which would be the bottom part getting into the shaded green area.
But we've got other risks, right? And one of the risks that we've experienced recently is the recent surge of the Canadian dollar against the US dollar, and even globally diversified portfolios for Canadians are struggling. And this has become another dimension of risk. In this case, with stocks, with bonds, with the currency, it's a third dimension of risk. Any comment there?
Yeah, I mean, FX is one of the many risks that we have to manage. Stock market risk, individual stock risk, government bond risk, corporate bond risk, credit risk, and FX risk. So as you said, I think last week we did buy some US dollars versus Canada. So we bought US, sold Canada down at 124.5. We almost got the bottom, as you can see, it got down close to 124. And today we're up around 127. So that provides pretty good. Now, consider the currency to be, in the US dollar that is against the Canadian dollar, to be a natural passive hedge against the other risky parts of our portfolio, which would be namely stocks. So typically when the US dollar appreciates or goes higher, stocks typically come off, and this provides us with a bit of a hedge. So that's part of the reason why we did that.
And this has to be managed, though, right? I mean, this is why we have this argument about passive buy and hold, fully invested at all times strategies. They lose the advantage of the managing of some of these risks, right?
Absolutely. Actually, I was just going to, pardon the clicking, but in fact, if that U.S. dollar gets back up towards 130, we may decide we want to sell some of our U.S. dollars again, and we very well may.
Yeah.
Although, as you said, I think we can use them for purchasing U.S. dollar denominated stocks or indices as well.
And one of the things that we've talked about a little bit last week, we'll get into it a bit more here, but in U.S. dollar terms, the global equity benchmark that we monitor, the All Country World Index, and we use it to compare equity market performance against our global equity model. That portfolio in U.S. dollar terms is ahead by almost 18% over the course of the last year. But if we look at it in Canadian dollar terms, it's significantly lower. So it's less than 14% gain. And then when you build in what's happened to the bond market over the last year, I mean, it's down almost 2% over that same time frame. And then you put it on a comparative combined and weighted, fully invested 60-40, 60% equity, 40% fixed income comparison. The 1 year return has been reduced to a little over 6.25% after you include fees, and that's when you include that Canadian dollar strength. So it really does impact that fully invested buy and hold strategy. And if you look at it over a 2 year period, that same 60-40 balance has achieved only a 3.6% return. So again, this comes into managing that currency risk to try and alleviate some of the pressures that we do feel when currencies move. And as you said, right, we may determine at a certain point in time that, okay, well, let's move out of that purchase that we bought. So we bought it at almost at the lows. It's now rebounded. The U.S. dollar has rebounded significantly. The Canadian dollar is weaker. So over the course of the last couple of years, we've been tactically underweight U.S. dollars and U.S. stocks in our portfolios. Until a week and a half ago, we bought the U.S. dollars at a nice 10% discount or so to its peak. And the other important thing is that when we do these trades, we also do them simultaneously for every single client. And I think that's a huge issue, right?
Oh, God, yeah. But that's how we do every trade at High Rock, right? It's a one block trade, and then we allocate it through the system into everybody's individual account, all at the same price, same timing, same security, in this case, a currency. But yeah, that's one of the enormous benefits, in my opinion, of managing money on a discretionary platform with separately managed accounts.
Exactly, and it's not something that is readily available out there, or most financial advice givers don't have that capability. So we like to think that this distinction is very important and certainly works to our clients' advantages. If ever anybody would like to have a deeper discussion on what exactly discretionary portfolio management does achieve for you, Paul and I are obviously both available to have that conversation anytime. So, Paul, we've seen some pretty low levels of volatility in equity markets recently. What do you think about that?
Yeah, super low. It's been, U.S. stocks, and we should qualify that even by saying, and you had that data a few months ago, but something like, correct me if I'm wrong, 50-odd% of the move higher in the S&P 500 is related to half a dozen stocks or something. Those typical FANG stocks, but they've been moving higher for the last number of months, and volatility has dropped right off. And that kind of goes for for a lot of markets. I think currency markets have been, say for the Canadian dollar, reasonably stable. Bond markets have been hit back pretty hard in June and July and seem to be stabilizing now. But boy, the elastic band can only stretch so far, and then something's got to hit it.
And
there you
over
go.
the longer term, I mean, it's quite apparent that after you get a fair lull in volatility, inevitably there's a spike in volatility, right?
Absolutely. And volatility, just for our listeners, when you get volatility like that, it typically means the stock market going lower. So that big spike in 2015, upwards of 40% vol in the VIX, was the market getting hit, the stock market getting hit.
It was interesting because it was around that time that we actually received a significant number of calls from concerned, at that point in time, they weren't clients, but concerned investors, we'll say. And I think, that says something right then and there. People, when they see this kind of volatility, they get very, very nervous. Until they see that kind of volatility, they're pretty complacent, right?
Yeah, well, the time to manage risk is all the time, but not after the market gets hit. It's now. Now's the time to manage risk and make sure you've got a really good finger on the pulse of that portfolio and make sure that risk is being managed properly. Last thing anyone needs to see is giving back a lot of gains because their risk wasn't managed properly.
Absolutely. Well, having a more tactical approach to investing allows us to not have to depend on the less reliable old correlations, and they don't appear to be providing the appropriate portfolio balance anymore. And as a result, it does allow us to manage our and your risk way more effectively. And as I will every week, we have to remind everyone listening that historical returns are no guarantee of future returns. But as you know, at HighRock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you'd like to review any aspect of your portfolio or wealth forecast, please do not hesitate to reach out to us. Well, as we do each week, we shall just quickly review what our key themes are. Certainly avoiding risk when risk is high, and we think that at the moment risk is very high. This means being more tactical inside an investment portfolio. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for central bank policy and interest rates. The Bank of Canada raised rates a couple of weeks ago. The U.S. Federal Reserve has raised rates by about 0.75% since December, and it is now expected that they may raise them again at least once more this year. Rising borrowing costs and reduced financial system liquidity may increase volatility as we move forward. Stock prices and valuations are close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction. Economic growth does not appear to be supporting the current valuations. And the Trump agenda has so far failed to bring a new healthcare option and improved progress on fiscal stimulus. There's Brexit negotiations, NAFTA renegotiation, there's tensions with North Korea, with Russia and the Middle East, as well as global cyber attacks and terrorist threats, all adding to the blend of political uncertainty that confronts us on an ongoing basis. Well, the evolving inflation story is one of our important themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should be growing, but this does not necessarily appear to be the case at the moment. Now, all central banks have a mandate, as I said before, to maintain price stability. Interest rates and monetary policy are used to keep inflation at targets of about 2%. Currently, only the Bank of England is dealing with inflation above that level, but they are also dealing with Brexit and an economy that has stalled. And last week, the Bank of England voted by 6-2 to keep the bank rate at a record low of 0.25% on as widely was widely expected, saying GDP growth is expected to remain sluggish in the near term as the squeeze on household real incomes continues to weigh on consumption. Well, the European Union economy continues to show a small increase in growth, but inflation continues to be well below target. In Japan, it's a similar circumstance, and even so in the US. But in Canada, it's been quite a spike in the GDP, and a good portion of that is attributed to the housing market. Paul, you've done some pretty significant work on the Toronto housing market, but do you have any take on what's going on here?
Well, you mean just across the country as a whole? Sure. As you can see, the white line is the GDP number at 4.6 on an annual basis, and CPI in yellow at roughly 1%. And that's not core CPI, it's headline CPI. What's interesting is that housing in Canada is roughly 23% of the economy on an indirect basis. So it's a very, very big, it's the largest component of our economy. And obviously Vancouver and Toronto were kind of leading the way. Now, the housing market has cooled substantially in Toronto to the tune of roughly 15% over the last 3 months of May, June, July, whose numbers just reported last week. And this is why the Canadian dollar, that GDP number, the white line, is why the Canadian dollar has rallied so much. In the Bank of Canada, several officials at the bank came out and started talking about hiking interest rates. And we've spoken about this before, Scott, a couple times. That's why the Canadian dollar rallied or moved so strongly, so quickly. But our view, and why we bought U.S. dollars and sold Canada, is that A, inflation is very subdued, as you can see. B, housing is a huge part of the economy, as I said, about 23%, and it's come off substantially certainly in the biggest city in the country, Toronto, and that is likely to affect the economy. And C, the currency moves so strongly and so quickly that it's going to hurt exporters. They can't adjust that quickly. So there's a few reasons there why we think the Canadian economy could slow over the next quarter or two, rather substantially, in my opinion. So that would be not a good sign for the Canadian dollar, but would be good for Government of Canada bonds. So we are positioned pretty well for that type of economic movement.
And our expectation would be to see that spike in the white line actually turn and do a bit of a nosedive, I would imagine, right?
Yeah, for sure.
Yeah. Okay, well, we also have been paying close attention to the global debt situation, borrowers' ability to service that debt. And when interest rates do move higher, that also becomes an issue. Global debt is at record levels, and in the US, it just came out over the last couple of days that credit card debt is now higher than it was prior to the recession that began in 2008. So again, these are important things that sort of aren't they're not the headline issues. So they're issues that we keep an eye on, and a very close eye on, because they could become impactful in time. We say each week, and this is not changing at this juncture, that stocks are expensive. Earnings are expected to grow at only a rate of 6.5% over the next year. And stocks have already built in a rate of growth of 27% above the 10-year average. So to us, it just doesn't make a whole lot of sense to be heavily invested in stocks. And another metric that we talk about often is actually still at pretty much at its highs. There are geopolitical issues. Certainly the Trump administration has been struggling to move its agenda forward, and they're running out of time to do the necessary raising of the debt ceiling. So we're keeping a close eye on that. And of course, while the UN voted unanimously to sanction North Korea turned around and threatened that they were prepared to teach the US a severe lesson for any military action against them. So that's out there.
And Scott, Scott, I'm just reading a headline here on Bloomberg. Trump ran a press conference at his golf resort in New Jersey, and I'll just quote: "North Korea best not make any more threats to the United States. They will be met with fire and fury like the world has never seen." There you go, from President Trump.
I don't think we need to hear a president of the United States speaking in that manner, but if he does, then it only raises the issues, doesn't it?
Yeah.
Well,
let's hope not.
There you go. So these are uncertainties that concern us. The market seems to shrug them off as political posturing, but we do have to keep these things in the back of our mind. And of course, at High Rock, we continue to work hard to get portfolio growth, but we are very uncomfortable with the risk at the current levels. We think the U.S. economy is in its late stages, so it just makes us uncomfortable. And having too much risk in our models and our portfolios just don't make sense. We've all worked too hard for our money, and we want to make sure that we invest it prudently.
Scott, I could just add too that we did add some positions for some newer clients, mostly in some stocks. We did add a corporate bond for some newer clients. So we have been picking our spots here and there to try and add a little bit of value when things dip down.
But all in the context of the risk that we see out there, obviously, right?
Yeah, absolutely. And as I said, largely the additions we did were just for newer clients. We haven't really added much risk. And the only other thing I would add is the energy space in general in Canada continues to get hit very, very hard. It's had a rough, and that's why the TSX on a nominal basis is the only stock exchange in the G20 nations that is actually down on the year. And I think largely because of our oil and gas or energy space, including oil field service companies, et cetera. So we had limited exposure, but what we did own certainly did not add value to our portfolios. And we're remaining on the sidelines. So we're trying to be very disciplined on this front in the energy space.
All right, great. Thank you. Okay, well, that's it for this week. As always, we want to thank you for taking the time out of your busy schedules to tune in. We have been trying to make this webinar more of a dialogue. I hope that it's been working for you. We are focusing on topics that we think are worthy, but we would love to get our listeners' ideas of what they might want us to talk about as well. So please feel free to send us any sort of feedback that you want. We have got lots of feedback, but we are still, we now have our High Rock hat, so we're about to do our High Rock draw, but if anybody has feedback, they want to send in something and get their name in for the High Rock cap draw, then that'd be awesome. But we will be back with our next update next Tuesday. Until then, this is Scott Tomlinson on behalf of my colleagues Paul and Bianca. We want to wish you all a great rest of the week and a wonderful weekend coming up.